All right, I think adding everyone, getting everybody joining. There's been a good response this month. So, Guy, thanks for joining. It's kind of our annual February. I call it our State of the Union call. You know what's going on, what happened in the market, what's going to happen in the market, and then we have some kind of unique twists this year, just kind of how that applies to you. But I know, Guy, last year we had a long call. You brought on a couple. I think we had Jordan on and Tom on, just talking about different segments and different parts of the market and how you thought it would work. But do you want to just maybe we start the call with a little bit of a recap of 2023, and especially from what you kind of saw in the beginning of the year and then what played out, if that makes sense, that we saw happen, and then we'll move on to this year, if that's okay.
Yeah, no, absolutely. That's a good place to start. And I'm glad to see, yeah, a lot of interest, but I guess when it comes to the markets, it
Everyone's
tends to pique
interested.
people's interest, right? There's always a
Yes.
lot going on. So um,
And I guess
but
while you said that too, if anybody has questions, we had some questions ahead of time. We'll leave some for after, or if I see something specific come in, but you can put that in the chat if anyone has questions. So,
Yeah, and absolutely. And what I'll do is I'm going to kind of hit on some of the, really key, what we think is really kind of the key major points, but we have a good quarterly letter that we just put out. If people haven't seen it yet, I would make sure to get everyone because that gets even more in depth and some specifics and brings charts in and all that type of things to help support some of the things that we're seeing and but today, at least, I just wanted to hit more on the, kind of the more major points of what we think could be continuing to drive the market one way or the other. So what we'll do is circling back to where we were about a year ago. This is probably a good spot to start because, like you said,
yeah.
I was on with Jordan and Tom Healy to just cover, and that was especially because we were coming out of 2022, which was a historically bad year. Just because especially we were hitting a bear market not only in stocks but one of the worst markets in history for bonds at the
Right.
same time. And the reason that it was happening was not even economically driven. It was the only economic circumstance that was primarily driving that was inflation, but on the counter effect was it was all rate dependent, because at the end of the day in 2022 it was a positive earnings year for the market overall that led to that kind of movement down. So it was an important time for us to kind of come in and say off of that what we were seeing and how we had preserved to a certain extent in certain areas through a lot of the damage of 2022, but more importantly, how we were taking advantage, how we were kind of positioning into things that were overly done in 2022. But really the key that we were really focusing in on about a year ago going into last year in 2023 was two things. Firstly, we were believing that we were towards the peak of the hiking cycle, right? That regardless of how many more hikes there were, we were very confident that we were much closer to the end of it than obviously we were at the beginning. And really, even in the first quarter of last year, we felt we were pretty much towards that top end of where they were going to be peaking out from hiking rates. And and the reason behind that was because we were looking at a lot of the leading indicators that, correspond to inflation, which is obviously what the Fed was really focusing in on. And you start to look at things like money supply, the price of gas and oil, some of the housing rental starts and rental costs, all that stuff was dropping and actually dropping pretty significantly from their high points in mid 2022. So while the CPI numbers were still edging up, we knew that that stuff was eventually going to bake into the CPI numbers, which would come down. And since that stuff wasn't going up, we knew the CPI likely wasn't going to keep going up. It was just going to mellow out, hopefully keep trending down. So that compounded with the fact that in the first quarter we also saw that when because the Fed was hiking so much, it was causing a big issue for the banks, because a lot of the banks had locked up long duration bonds with some of their extra deposits that were now really underwater because of how much they hiked. So it was just further justification that the Fed had to keep their eye on that, and they couldn't just keep hiking indiscriminately because it was going to potentially cause a banking crisis. You know,
Mhm.
if they brought Fed funds rate up from 5 to 6 to 7, you know, it would have caused potentially a bigger issue with the banks. So those two, you know, those aspects are why we felt we were towards the peak of the hiking cycle. And the second side of it was we felt that we were not about to fall into a major recession, which was a lot of the fear in the market at the end of 2022. And the reason we felt really confident on that was because of how strong employment was. You know, it was not only strong, we were at record employed numbers in the country. And, you know, with increased wages and other numbers behind that was we had, you know, higher savings rates than we did pre-pandemic. So all that stuff is what it means is you have a very strong consumer still within the economy. And we know historically that we've never seen a major recession when you've seen that much strength in the consumer and that much strength in employment. And when some of the people that were really calling for recession were looking at some things like an inverted yield curve and putting a lot of weight on that, which we knew that was more having to do with a really weird circumstance in 2020. And, you know, and then the way the Fed had to react to that. So those were our 2 points that we felt we were towards the peak of the hiking cycle and that we weren't necessarily going to head into a major recession. So to take advantage of that, we were making sure that we wanted to be in quality, so quality businesses, quality stocks. And then on the other side, even on the bond side, just, you know, longer duration bonds that had just gotten way out of whack and were trading even cheaper, almost indicating that the Fed was going to keep hiking. So those were the things we were focusing in on. And the only thing as we never know, is timing, right? You know, so the timing of the market, as it turned out to be last year, is really in the first half of the year, market growth, market strength was led by what they coined the Magnificent Seven, right? So essentially that's NVIDIA, Meta, Apple, Alphabet, which is Google, and Tesla. You know, those 7 stocks really for the first half of the year led the majority of the growth. Now, luckily for most of our core strategies, we had pretty much 6 out of those 7 in our strategies. Tesla has still never made it in, and you know that's a valuation issue that it's just that's a tough one to make it in. But you know we did have exposure to those, and really what was happening with those are very strong, very profitable companies that were bringing in, you know, hundreds of millions of dollars of quarterly revenue even through 2022. But despite that, they were getting sold off in 2022 at an extent that was almost not making sense. You know, they were getting so cheap despite how strong they were in an environment where, you know, for a company like Apple, it doesn't matter if the interest rates go up because Apple has more cash than certain countries do, that they don't need to rely on on borrowing to finance not only their costs but their growth. You know, and that's the case with most of those companies. So that's why part of the key of 2022 was, besides offsetting in the foreground, just, you know, where you could do to preserve a little bit of the initial downswing. But when you start to see those types of dynamics, being able to step in and buy a company like NVIDIA that was now trading much lower than it should have been because of rate fears and nothing to do with the company itself. So that, you know, taking some of those actions in 2022 is what drove a little bit of the returns in the first half of 2023. But if you took those 7 stocks out and you looked at the S&P 500, the other 490 plus stocks on average were pretty flat in the first half of the year and didn't participate with most of that growth. And then what happened is, you know, after the summer going into early fall, Fed came out with more notes that kind of started to spark some fears that they might keep hiking. That caused an overall sell in the market in early fall, which finally it came to fruition or came to resolution in November, when those CPI numbers and some of those inflation numbers that they look at finally started to fall down into the right ranges. So basically the lagging indicators were finally showing what the leading indicators had been showing for months. And then very quickly, the market reacted to that. And we ended up getting the type of outcome we were anticipating in the very beginning of the year. But a lot of it happened in the last 2 months of the year and it was really because of rate perceptions, because of these rates or these data figures that were coming through and finally hitting kind of those lower aspects. So that was basically kind of the gist of what happened last year. It kind of followed through what we were anticipating, just not on the timeline we would obviously predict. And I don't think that's the key. You can never predict the exact timeline, but that's why you have to kind of keep your eye on those metrics. And as long as those aren't changing, you got to hold through with your strategy.
And that makes sense. And I think something key you hit, and just kind of reiterating why, all our portfolios, all the portfolios you have managed, after they hit a certain level, are managed with individual stocks and bonds. So you can hold those funds and actually buy them at a discount. And the reason some of those Magnificent Seven were falling so much is because they're also part of the big pooled strategies, mutual funds and ETFs. Almost all of them have some or all of those holdings, depending on the fund. And if you sell out, so even if you didn't sell your fund, somebody else does, they have to sell proportionately, right? They have to manage towards the prospectus, not to the individual, which allows you, when you're kind of coming in there more agile and nimble, to buy those things that are being sold off and then to hold them individually and buy them at a good price. And so I just kind of wanted to point that out. I know it's something we talk about a lot, but that's why we have the individual stocks and bonds portfolio, and why we talk all the time about that pooled strategies become inefficient after you get to past, let's say $80,000 or more, just because you can't do those things in a pooled strategy. And no matter how smart the manager is, they can't say, hey, I'm just going to hold the Magnificent Seven, or I'm going to buy more of it, because they have to really manage toward the prospectus, correct?
Yeah, exactly. And that, you hit on it. That was exactly why we were able to take advantage of some of those things in 2022. I mean, that was the reason a lot of those stocks were falling. It's just because they held a big weighting in the indexes. So people were selling their index funds, they were selling their mutual funds because they were scared of the overall market. It wasn't because they were really worried about Apple as a company, or they were really worried about Google as a company. It was, they were selling because the market's going down. So off of those initial sells, those really strong, good quality companies, where it was the term, throwing the baby out with the bathwater. That's exactly what was happening, which, when you know what you're looking at, you can start to take advantage of that, because you can be buying those things at levels that they shouldn't be priced. And this was probably one of the most convincing 2-year span of that dynamic happening, because it absolutely happened in 2022. And then you saw in 2023, in the first half, how quickly those names started to come back up once sentiment changed, and some of the fear of the rates started to come out a little bit. So
then with that said, I think that's probably a perfect segue into what do you see, what are the good buys, or what do you see kind of coming up in this year?
yeah. So this year too, it's like always, there's always interesting dynamics heading into it, because now, people's thought would naturally go to, how strong of a year we just had last year. So that can't continue into this year, and I was even speaking with my mother-in-law 2 days ago and asking, how's the market still going up? And, we're going to have a rough 2024. And I had to remind her, I'm like, well, in a typical cycle, we don't typically go through bear markets every 2 years. It's, which is, we're on that pace right now, 2020, 2022. So, typically 2024 would not necessarily be another bear market. And the reason that things were going up already to start is because we've gotten some good earnings results already to start in first quarter here, especially in some of the tech names. But But when we're looking now going into this year, so now like some of the things that we're focusing on, we are still keeping our eye on those economic fundamentals that we were focusing in on last year. And while we still see a lot of those strong dynamics, we're also cautious of some other things that could show potential contraction in GDP and things like that if they come through, and housing numbers, things like that. Some of the things that have been great for inflation, could that have a little bit of a lag on GDP and things like that. So because of that, we're making sure that we're taking out any of the premium stocks, so those Magnificent Seven, some of the big winners from last year, we're not letting those get overweighted. We're taking some profits off of them, getting those down to normal weightings in the account while they can still continue to go up. Things that are at a premium, if we start to see a little stumble in economic data, those would be the things that would fall harder quicker. Versus on the other end, what we're very conscious of is that even though we got a really good rally into the end of the year last year, not everything participated the same. And so you still look back and you look at defensive stocks, you look at small cap and mid cap stocks. Those are still all trading at a relative discount to the large cap names because they did not rebound, they did not recover the same way that the large caps did last year, and they still have more room to go. So if things continue to be strong on an economic standpoint, those should not only participate, but arguably they should even be outperforming because they have more room to be catching up still. But on the other side, if we do see a little bit of a stumble, then they're not going to fall as hard because they're still discounted versus the things that are maybe at much higher valuations right now. So that's one thing we're keeping our eye on, where valuations are, starting to take profits from the things that really worked last year, the Magnificent Seven, some of those tech names that are really at the higher valuations, and re-putting it into things that are still at lower valuations and still have room to be catching up. But why I still think in general, the market, there's still a lot of positive support for the market going into 2024 now, is because, besides the fact that, those same economic numbers that we were mentioning are still holding true, we're now in a position where we're anticipating that the Fed will likely do some type of rate cuts this year. And what people have, I talk with, what they have a hard time justifying is why would the Fed cut rates if things are going so well? Why not just keep them here? Especially because, it helps with short-term savings rates, things like that. Well, the reality is, because if inflation is really down low where it's kind of indicating, so it's under 3% right now when you look at CPI, and if it does trend down towards that 2%, which is where their target, where they're trying to drive it down, having the Fed funds rate over 5% right now, that's still a measure of tightening, because it just means that the Fed funds, they're 2% over where inflation is. So just because of that dynamic, they're going to want to cut to make that gap. They still want to be above inflation, but they don't want to have over 2% spread to it. So naturally, that's going to cause them to want to start cutting. And so if they cut, now we have a dynamic that not only can things do well if economically they still hold up, but we can start to see what's called a multiple expansion. We saw a multiple contraction in 2022 because of how quickly rates went up. But if rates start to go back down, then people will be willing to pay for more for a stock at the same level of business that they have, because interest rates are lower, so their alternative is not as good. So that dynamic can still happen. Both of those at the same time can still happen. And what's also another really interesting point, if people are really worried about a big economic slowdown that didn't happen last year, but now is going to maybe happen this year, which I still don't see, because the employment data and all those other things are still very strong. But even if that does happen, well, now that's justification that the Fed's probably going to cut even more. And in that case, stocks might actually like that, and bonds will like that. So it's kind of a setup right now that there's a lot of safety net for investments because of where the Fed has positioned themselves. And the way that they will react if we do start to see issues. And then we have other things with, the presidential election coming up this year. You look historically, usually those types of years are positive for the stock market, and there's a whole bunch of factors for why. We could do a whole recording on why that's usually the case, but one key reason is that the market, more than anything, it likes certainty. So we will know, after the November election, to a certain extent, a little bit of certainty of maybe what to expect now for the next 4 years or so, and the market tends to rally off of that. So it's a backdrop for continued growth and continued strength within stocks, and if rates are continuing to trend down, that's going to be very positive for bonds. But we always do, we have to manage the risk. We're just making sure we're shifting away from things that are at higher valuations that have had really good growth already, shifting to things that are at the lower valuations and have a little less downside and more upside to them. And that's kind of the best way to position it going into this year.
Makes sense. And I think, well, a couple things, like last year, one of the things we talked about is, small cap was not where you wanted to be at the time, because of just some of the things you just pointed out. And now there's a transition where, hey, now that's probably where we want to be. So it's important to kind of see those. And then the next thing I just kind of, would say is, well, you just said election years often end higher. Sorry, there's a phone ringing that I can't shut up at the moment, but while they end higher, there could be some volatility in the meantime. So understanding kind of, you just kind of pointed out, there's some good things to be looking at, so that short-term volatility doesn't necessarily mean, the end of all things. But as we were talking before, I mean, you hit on the fact that even though you say these things, again, nobody knows exactly the timing. We don't know timing. It's just about positioning based on what you're seeing. And I think that kind of goes into the next thing we were talking about is how you're positioned is different based on where you're. I mean, it's kind of two things. What do we see going on in the market? What's available? What things can we take advantage of, opportunities? But then the second point is, where are you, in life, in your investing cycle? So someone who is 30 or 40 and putting money away for retirement is different than someone who is, 60, start going to retire and start taking the money out, right? And so I just wanted to speak on that for a second, because I know we've done lots of calls just on that shift and retirement, or different things and phases in life. And again, not everybody in retirement's not the same. It's different if you're using that whole portfolio, your whole account, to generate retirement income. And that's different than if you're letting it grow to pass on to beneficiaries someday, right? And so I think that's a key that I just wanted to hit on a little bit. And if you want to touch on it some about really, and let's just kind of focus on where the majority of our clients say is, and I would say the largest area where you could, if you're not positioned right, hurt yourself the most. And that's like in that transition when somebody is, okay, either transitioning from working to retiring, or from, saving to now generating income from their savings. And so I'll touch base on the fixed side in a little bit, but if you want to touch base on, how you see that based on all these things, what are some important things to look at for someone in that phase?
Yeah. No, and so it always kind of circles back to the things that we like to focus on when we're doing portfolio construction. And the first is really cash flow need, right? Or income. People, it's taking, once you're into retirement and you need to start taking income from the accounts. But to us, we label that as cash flow, because income can be generated in more than just being in stocks or bonds that are paying out an income. Cash flow can get generated from taking profits from appreciation in stocks and bonds, along with the income that they would be paying out. But kind of determining where that cash flow need is then what's going to help determine the positioning, because what we look at is volatility risk. What is the volatility risk of the portfolio potentially, based off of how much exposure it has, not only to stocks and bonds, but certain types of stocks and certain types of bonds, because we understand that correlations are what's key to keeping a balanced portfolio and keeping a portfolio that works through all different types of market cycles. Because even going back now to 2022, because that's a pretty good example now of an extreme market where almost everything was down except not energy stocks and not healthcare stocks. Energy stocks were up over 60%. Healthcare stocks were up 20% or more. And, some of the communication stocks. So it was key in that environment to have a blend of those along with, on the bond side, short-term or inflation protected type stocks, type bonds. So having the appreciation in at least those segments within the portfolio, along with the income that was being generated, should be enough to help make sure that you're meeting your cash flow need for the year, even in a really bad down market. And it ensures that you're not having to sell depreciated stocks or securities that are not at a good level to be selling to meet that cash flow need. So that's what really, from the portfolio construction standpoint, is important, is making sure that you have enough to generate that cash flow need. And I usually like to put it out, between 2 and 3 years is going to be met through the income generation and just having that non-correlation of positions in there. And that really changes once you get into retirement, because pre-retirement, that becomes less crucial because you don't need to be taking cash flow pre-retirement necessarily. So in that case, you arguably could be seeing a little more volatility risk, because in the short term, you don't need to be selling anything to be taking income. And arguably, if you're still working, you're in a savings mode. I know it's hard psychologically for people to get there, but as you're building and you're adding to the accounts, you almost hope for those market pullbacks, because now it means your new money is going in on sale, and you're going to be better off in the long run by being able to buy in more when the markets are down like that. But that's absolutely right, Michelle. Like that's where it's a big switch when you go from that accumulation phase where you're net saving and you could be kind of buying into the volatility and taking advantage of it, to then flipping over onto the distribution phase or the withdrawal phase, because it's a compound effect. You're no longer saving into it. Not only that, you're actually drawing from it. So now you got to switch things out to make sure that you're in a position that you can always be meeting that draw down in a strong way, given any type of market. But then still being able to position the rest of it to try and participate with growth when there's growth to be had.
Yeah, and I think I'll add this, as I mentioned earlier, we have some videos on the site that we'll kind of include in a summary too, or when we post this, but we talk a lot about, that's why when we construct a portfolio, it's using those individual stocks and individual bonds because it gives you more agility that we just talked about. And that is the difference than if you were to just pull your money from your 401k or pooled strategies. It's really, really important that when you're coming to retirement, you actually have a plan on taking income out. And that plan revolves more than just, I'm going to take, 4% or 5%. For example, Morningstar, puts out their safe withdrawal rate, and it had dropped a little bit in the past couple of years. It might have come back up a little, but mainly because they're looking at the risk you just said. Now, when you're taking income out, and if the market falls, that could hurt your long-term plan. But if you have someone who, like Guy and the team behind the scenes saying, hey, we already know we're taking this income. So for our clients, it's as easy as we're taking 5% out. But behind the scenes, you're not just, withdrawing 5% randomly from the account or, across everything, but knowing where it's coming from in the strategy. And that's, I think, the key thing to know. It's not that each individual person needs to know this, but you need to know your team is planning on how you're taking income and how that's being protected. Which I think kind of segues into a little bit on the fixed side. And I'll just kind of hit on that some too, because of course we've done a lot with the fixed indexed annuities and, even fixed rates. I had people call with CDs, paying over 5%. Like last year when we talked, Guy, I'm sure like they were not paying anything close to that, right? I mean, for years they paid like 0.1 1%, like nothing. And so now that the rates are higher, yes, it's benefited things like CDs, fixed annuities, and even fixed index annuities, which, we've done whole videos on that. But I guess the thing that I would want to hit here is one, we've talked a lot, on different videos about refinance and reverse and taking those things that are in fixed rates and can we get, better fixed rates right now, or even on the fixed index annuities, better caps, better while the interest rates are high, which is something that we've been trying to proactively go through with every person, we're looking at it, and taking advantage of that. But on the flip side, I also see some people go, oh my gosh, the CD's, 5%, I'm just going to take all this money and put it here. Well, again, it kind of comes down to making sure you have that long-term, like, I want to just say long-term plan, right? But what's the goal for that money? Guy, we were talking yesterday about some clients that wanted to, buy a house in a couple years. Well, how they manage that and what they do at that point, it's okay to take advantage of something, a 5% CD for a year or two, because they're going to use that money. However, someone who, if that's not your goal, if it's going to be to create an income or something, we have to be careful not to fall trap and put something in a 5-month, a 1-year CD at 5%. And the next year the rates are lower and you're going, oh, now what do I do? Right. So it's important to position things in a way that doesn't just take advantage of something for a couple months, but long term. With that said, I mean, you had mentioned you're taking advantage of some of the bonds. I mean, treasuries are paying as much as CDs are, and taking advantage of that in some of the portfolios. And so I think it's important, just we kind of hit on that, like, yeah, we want to look at where the fixed rates are and maybe some of that, fixed indexed annuities with higher caps right now. It's a good to take advantage of it, maybe move some money, but it all comes down to what is really your goals for the money and your needs, right?
Yep.
Yeah, I had someone yesterday say, well, I'm getting older, so I think I have too much in the stock market now. I was like, well, it really comes back to, again, what is your goals for the money? You're not needing all this money for income. You have some protected. We have risk management in place, so we don't need to listen to some necessarily boring rule of thumb that just says we have to take this much and put it in safety at this age, right? It really becomes planning for each person's needs.
Yeah, absolutely. Well, that is always one of the things that drives me craziest is the rules of thumb based off of age. It's just so it's a lazy way of looking at things because it's more per everyone's particular circumstances because we have people that are in their 80s that have 70% of their portfolio in stocks and it's purely because it's at this point they're positioning it for the next generation because it's more than they even need. It's
Mhm.
they're living primarily off of pensions and other things that they have or and they take a small amount from the accounts every year to live off of. So in their scenario, it makes sense to have more growth because ultimately it's for their kids. So but the rule of thumb would have said, you need to be 20% stock because you're in your 80s. So it really is. It's dependent on everyone's particular needs. And that is one thing that we've been having a lot of conversations with people now about, and certainly in the last 6 to 8 months because of those short-term rates and really the CDs. And you hit on it exactly. It's almost becoming a little bit of a trap for people because they're seeing that high, rates that we haven't seen in 15 years, which is great. But on the flip side, if you're abandoning the long-term strategy to go try and grab the quick 5%, the problem is you don't know where that's going to be a year from now, right? And even on the bond side, what at this environment, if we're really at the peak like we think we are, and I think the market at this point is feeling that way, and things are going to be going down, it's time on the fixed side to be locking in longer duration. You want to be locking in those higher rates for longer. So, rather than getting in the 6-month T-bill that's paying, 5.3% on it, which is an annualized basis. So that really means the 6-month T-bill will give you about 2.5 or 2.6%, and then you got to roll it into another one after 6 months. You could be going into some municipal bonds that are 20 years out that are paying close to 5%. between 4.5% and 5%. And in the long run, what's better, taking the thing that's going to give you 5% for 1 year, and then next year it might be at 3, depending on what the Fed did, or locking something in that's making 4.5, but you now have that for 20 years. So that's where it's important to be looking at right now in this environment, because it's not going to be here for very long. Especially if the Fed starts to cut, those short-term rates all of a sudden are going to be reflective of where the Fed is going. So what did you do before that happens to take advantage? And what'll happen at that point is once the rates start cutting, by the time you're getting out of that CD and now you're looking and you're saying, oh, I can redo it at 3 now. Well, rates will have gone down. Bonds will no longer be yielding the way that they were. You can't get the 4.5 for 20 years anymore. That'll be closer to 3.5 or 3. And stocks likely will have rallied, and now is not the time to be putting it into that other stuff.
Right.
So that's the thing. It's just being forward looking and realizing that yes, those things serve a good purpose for, especially money that is more immediately needed and you can't have any type of short-term volatility risk. That's what that really should be for. But then on the other end, you need to be looking longer term, because when those rates disappear, the rest of the market will have already adjusted.
Yeah, and very key, and that's why it's important. Even when we're looking on the annuity side, we're not going to just do a fixed year for 2%. That doesn't help us out, right? Like, how do we take advantage of these rates for a longer period? So you mentioned longer term bonds, even like on the fixed side, the fixed index annuities, when we're doing a 10-year, we're having higher rates for a longer period or a guarantee for a longer period. So again, all those things to think about. And I know we're over time, so I'm going to make this quick. Actually, I had one question come in, but multiple questions in the last couple of weeks about gold and silver. So we're going to just address this really quickly. There is a lot of, we've talked about this so many times. Gold and silver, when we're talking about the physical metals, becomes like a wealth insurance, and it's once you have all your income needs met and things like that, if you put maybe 10% in the precious metals that are physical metals that you take in your possession, it's kind of a long-term wealth insurance against inflation, currency, all of that. But that is very, different than kind of looking at it as a currency versus a commodity, which I know you have some in your portfolios with the gold and silver too, to take advantage of those markets on the commodity level, which you can talk about here in a second as I pass it back over. But the other thing I want to say in that is right now you're seeing a ton of marketing from companies on gold and silver, and they're really it's almost like there's just not a whole lot of regulation in that industry. They've called clients and said, you need to move 50% of your IRA into gold and silver. That's if they do that, they'll probably have half of what they would have had. Because it is not a short-term fix. It is a long-term type wealth insurance. It's not all the same just because they tell you we have these fancy gold bars. Gold is worth what gold is worth. And so they're probably giving you they're taking it out in prices and fees and whatever they did. So it's really important to be cautious on that. So if you have questions, we have gold and silver experts that can help that. Again, it's part of a wealth insurance. I know you use it as part of your strategy, but kind of two different versus having the metals in the strategy. So you can touch on that. And then the last two questions too that were issues, what about government jobs? Does that account for a lot of growth? Is that something to be cautious of? And what about the, mounting mounting debt in the country? Is that something to be concerned about? So if you just kind of want to end on those couple questions, if you have to jump off, you can, but if you want to end on that, that'd be awesome, Guy.
I guess on the commodities front, then you kind of hit on it a bit, because it's from when you're looking at something like gold, there is a value to it, but the difference when I'm looking at that versus whether we're looking at stocks or bonds, finding the intrinsic value of that is very hard, because it's really based off of what someone else says it's worth, because there is no business behind it that's paying out earnings to you, like you would with a stock, and there is no interest that's being paid to you like a bond would. It's really, gold was the original Bitcoin, right? I guess for some people there's more to it, because at least it's a pretty shiny material you could hold in your hand. But gold in itself is a soft metal as well, so it doesn't even have the same utility as most other metals do. But historically, through humanity, it's always been kind of the core of wealth. And it's that dynamic is not going to change. It's still going to be there, but its pricing is very hard to predict because of that, because that's the only thing that really backs it. So it typically, I think what people look at is it's a good currency hedge, because currencies can continue to go down because, you know, the dollar or whatever it is weakening. Well, gold can potentially hold its strength. And so I think, Michelle, that's like what you were saying, is using it as a lower percentage as an overall wealth or currency hedge. You know, that's probably the most appropriate way to be using it. We put it in the portfolios from a technical perspective, because we, you know, you can see the charts, you can see when there's momentum, you can see support and when people are stepping in to buy. So we usually will put small positions in where we see, all right, there could be more upside here, and then we might be out of it from a tactical perspective. But yeah, but putting way too much overweight in that is very risky, because it's really, you can't correlate the actual value of it, unlike other things. And we've even seen historically there's been periods of time where you would expect gold to do well because other things in the market are not, and it hasn't, you know, and it's acted like the markets. So absolutely, that's you have to be careful when you're putting a commodity like that in the whole big picture. You know, on the, I guess, on the jobs front, even though yes, you know, obviously there's a big segment of government payroll. A lot of the payroll data is focused in on the private side. So it's a lot of broad strength. And even when you're looking in the more public market, this number has been coming down, but you know, because at one point there was over 2 job openings per active looking applicants that were out there. You know, it was over a 2-to-1 ratio. I think that has now come down a bit, where I think it's 1.5, but it's still over 1. You know, so it is a broad market. It's not just government based. It's not just based on, you know, a scenario that if an administration changes and they decide to cut a bunch of, you know, spending there, that we're going to lose all the employment. A lot of it is in the private sector. It's not just government based. And the other side, so on the debt issue, yeah, the debt issue is something that, you know, obviously we would like to see get more into control. And I mean, it's obviously gone, it's gone even, you know, worse since COVID. And, you know, a lot of us are seeing those numbers. Behind the scenes, from an overall balance sheet, one thing that the Fed has been doing, that beside everyone's focused about the rates, but the other thing is they've been having a big fall off on the balance sheet. You know, so what they were doing during COVID, it was not only monetary stimulus in terms of cutting rates essentially to zero, and then the government giving out fiscal stimulus in the forms of actual, you know, checks and payments out to people that qualified. But on the other end, the Fed was actually building up the balance sheet. You know, they were acquiring a lot of debt. They were buying a lot of debt to bring in additional support to things, and you know, which was all adding to the issue, all adding to the problem, right? You know, so behind the scenes, the Fed has been having what's called a roll off, where they've been having billions of dollars of debt roll off of their balance sheets through the course of last year. That, you know, that's not even really being reported on unless it's something like we're looking at, you know. But that's another form of tightening. You know, so things like that are improving. You know, from the debt side of things, obviously some things I was pointing to early on was, even though we were increasing the debt, if they were financing it at very low interest rates, it's actually better for the taxpayer, because, you know, you're basically, the amount of tax revenue you will be pulling in will be more than supporting the low interest rates. So some of that initial front loaded debt that was done through COVID was being able to be financed at better levels. And so it was actually a net benefit financially for the taxpayer. But as those lower levels are rolling off, the key is that they need to start getting it under control. It can't just keep ballooning. And
Yeah.
I think that is something that's becoming more and more pressing, and it's more and more of a political issue and something that we're keeping an eye on. But just knowing the levels that it's at currently, because of the amount of GDP growth that we're getting, and with the GDP growth, the amount of tax collection that comes with it, it's still not at a point that it's non-supportive. Even though you're seeing the debt levels at record levels, it's still at a point where we're not past that point where it's going to, where basically that inflection point where it's going to become problematic. So it is something that obviously we're keeping an eye on, but because of some of those dynamics and the fact that the rest of the world still using the dollar, and you're looking at things like the euro dollar, it's something where it's not something that is still pressing that to the point that we need to be taking actions because we're worried about market circumstances now because of where the debt is.
Okay. Yeah, I think you hit on that. And, with anything, there's, again, things you can know, things you can control, and things you can't, right? And so the best thing is here's what we know that right now, and I think you just did a good, drop on that guy on what you did last year, where we're at this year, because this is the information we know, this is what's there, this is what we can go on now. And then every year that changes, right? And I mean, not just yearly, but ongoing things change, and that's why it's important to kind of be agile with what you're looking at and doing, and taking control of the things we can control, watching the things we can't, right? So I think that's kind of maybe a key too, is what can we control? How can we make sure it doesn't negatively affect your retirement? And then just watching to be agile with the things we can control, because there's certain things we can't, right? So
Yeah, that's exactly it. It's the way you go in, year out, and just you have to react to the data that you're seeing and make the appropriate decisions.
perfect. Well, I know we're late, but I wanted to answer some of those questions that had come in. So thanks, Guy, for jumping on. We'll have this recording, with as well as kind of a summary afterwards and some other videos. So you can go, that will be sent out next week and then available on our website for everybody. And feel free to share the information. But I'm sure, Guy, I know you and I talk all the time, but if not before, we'll have you on again next year and see where we're at and what happened from what you talked about this year and that. And I guess the important thing that we'll leave it with is, even though we talked about some things where you could think the market could do well this year, it is important, again, if you're in that phase where you're going to start taking retirement income, things like that, that you really have it set up in a way that you're okay no matter what happens. And so, there could be some volatility before, usually, as you said, Guy, an election year ends strong because of the certainty, knowing going into the future. But doesn't mean there's not any bumps along the way, as we saw last year. You were right on what you thought would happen at the end, but there was a lot of bumps along the way. And so that's why it's important to make sure that your plan, what you need, your income, that's all taken care of and protected. So if you have questions on that, reach out to me. I'll happy to call and talk about, if clients, what we're doing for it. If you're not a client yet, what we can do, or what we see, or maybe any issues we see with your portfolio that you want to take a look at. So, all right, with that, Guy, thanks for joining. I'm sure you got a busy weekend ahead with little ones, so have fun with that. Hopefully they feel better, and we'll talk to everybody next month.
All right. Thanks,
Thanks, Guy.
Michelle.
Bye.
Hey.